Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Meta. Trading near $7.18 per share, I currently have a buy rating on Meta stock, but there are several key factors that have a major impact on this thesis that I will go deeper on. I will give you the positives and negatives from the 2Q25 results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Meta, and my conclusion on Meta's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with Meta. Meta significantly beat Wall Street estimates on revenues and EPS, and they raised guidance. If you're enjoying this, please smash that like button.
Any news?
Let's cover the red flags first. The virtual reality black hole continues. This limits cash for buybacks and dividends.
The company has invested $65 billion or so in its Reality Labs division since changing its name to Meta in 2021. And it is unclear how fast the audience will grow for this totally new form factor. And it is technically challenging. A couple of live demos failed last night when the glasses didn't respond. Zuckerberg blamed the Wi-Fi.
Big cash outlay today for servers and data centers to help keep up with the AI arms race. The payoff is uncertain, but it seems like they don't have a choice.
Capex is going higher. There's no way to put it. We're at the beginning of the cycle. We've said this, that the enterprise adoption of AI is tiny. Your company, my company, we're in our infancy. There's just a few people using these tools today. We're all using it in our personal life, but we're not using it in work. And that's only going to grow, and that's going to fuel the next leg of this over the next couple years.
Earnings look better because of a useful life change, not operations. This benefit makes future year-over-year comparisons tougher.
In terms of the specific line items, cost of revenue increased 16%, driven mostly by higher infrastructure costs and payments to partners, partially offset by a benefit from the previously announced extension of server useful lives.
Meta still gets almost all of its money from advertising. If ad budgets tighten, there's no backup revenue stream. Europe is a big ad market. Policy changes can bite fast. This adds uncertainty to guidance and planning.
This could have a significant negative impact on our European revenue as early as later this quarter. We have appealed the European Commission's DMA decision, but any modifications to our model may be imposed during the appeal process.
A $2 billion acquisition of Revos, which builds processors for AI data centers, a $14.3 billion investment for 49% of Scale AI, which will help train cutting-edge AI models. Acquisitions are simple on the front end, but they're complex on the back end. Execution is critical.
Meta is paying nearly $15 billion for a Scale AI stake. I've confirmed with a source familiar with the deal. The information first reported this new number. A previous report had pegged it to about $10 billion. So this approaches Meta's largest investment ever.
Here's what got me really excited. Meta's core platforms, Facebook, Instagram, and WhatsApp, are still growing, even with a large base. More users means more ad impressions and data for targeting.
Meta's ability to continue to grow users and to grow ad revenue is what's driving it, but it's also what's in the future. The ability to bring Instagram, the social networks, the monetization models of digital ads, and of course, what they want to do in the AR, VR piece is all headed in the next 12 months. And that's where the excitement is, because not just the glasses, but it's also the new automation in AI. Meta is the most efficient company in the Valley from an automation perspective. They're going to be so efficient that they're going to be able to afford their super intelligence employees and, of course, the investments in AI that they're making.
Meta's core ad engine is performing on both volume and pricing. Volume and price growth creates a compound effect on revenue growth.
In Q2, the total number of ad impressions served across our services increased 11%, with growth mainly driven by Asia Pacific. Impression growth accelerated across all regions due primarily to engagement tailwinds on both Facebook and Instagram, and to a lesser extent, ad load optimizations on Facebook. The average price per ad increased 9%, benefiting from increased advertiser demand, largely driven by improved ad performance.
Revenue expanded double digits in every geography, not just the US. That diversification protects against regional slowdowns.
On a user geography basis, ad revenue growth was strongest in Europe and rest of world at 24% and 23% respectively. North America and Asia Pacific grew 21% and 18%.
Meta still throws off massive cash despite huge AI and capex outlays. Free cash flow is the lifeblood of a growing business, funding R&D and long-term growth. Huge liquidity provides safety and flexibility for scale investments. This gives Meta room to outspend competitors in AI.
The core businesses and the balance sheets are supporting these massive investments.
Large demand this early signals that wearables could become a real consumer business, not just research and development. Strong sell-through can attract developers and partners to the platform.
Yeah, Meta share is rising this morning, up about 1% now after the company showcased its new hardware. And the star product were these Meta Ray-Ban displays that I got to demo last night with an in-lens display and a neural wristband, which allows users to pull up messages, take and watch videos, get directions, and ask questions of Meta AI, as well as get the answers or recipes. All of that within the glasses. You see it within the lens. Now, these Ray-Ban displays, along with upgraded Ray-Ban Meta glasses and Oakley Vanguards, are Meta's most ambitious bet yet on hardware.
This is what everyone is missing. Meta's next-gen platforms, WhatsApp and Threads, are finally starting to earn. This adds new revenue layers beyond Facebook and Instagram.
Meta is, in every check, is blowing away advertiser budgets, taking share from Google, taking share from Amazon. And so, the kind of to his research and what we find, I think there's an element too of like what's happening in the public cloud.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
No thanks.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year-end, Meta had almost $44 billion of cash, and if we add marketable securities, it's almost $78 billion. Cash and short-term investments at the end of 2Q was $47 billion, and Meta was net cash, which means cash is greater than debt by over $18 billion. This gives the company a ton of money to invest in the future, whether it is AI, the metaverse, or share repurchases. In early 2024, PP&E was growing in the high teens, and now with massive AI investment, it's growing over 40% year over year. Meta has massive capex planned with their commitment to AI infrastructure build-out. While the company paid its first ever dividend in 2024, retained earnings increased by almost 25% to over $102 billion. Year-over-year growth in 2025 is above 31%, which is incredible. The fact that the company can pay over $5 billion in dividends while still growing retained earnings is impressive. So what's the takeaway? Meta has tons of cash, its debt is under control, and it is returning billions of dollars to shareholders, despite investing tens of billions into AI. This is truly impressive for shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Meta generated a massive $164.5 billion in revenue, with nearly 98% coming from advertising. Revenue growth was almost 22%, the highest level in 3 years. Year-over-year revenue growth was above 20% in 4 of the last 6 quarters, so the momentum is not slowing down. Over the last 6 quarters, margins have continued to expand across the board, from gross down to net. This is due to the tremendous cost discipline that Meta has been showing. After a rough 2022, Meta reached margin levels in 2024 that it has not experienced in 6 years due to layoffs and aggressive cost cutting. Meta achieved net income of $62.4 billion in 2024, more than the last 2 years combined. And net income year-over-year growth has averaged nearly 40% over the last 4 quarters, showing that the costs have remained low as revenue continues to grow. Because the company has aggressively cut costs, more money flows to the bottom line, which is great for investors. So what's the takeaway? High revenue growth combined with cost cutting means expanding margins and increasing profits for investors. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Meta is generating. While we see the increase in capex to fund metaverse investments and AI initiatives, there is something amazing going on here. Marketable securities generated $15.8 billion in 2024, a more than 2.5x increase from 2023. And in the first 6 months of 2025, Meta has generated over $19 billion. Meta is generating billions from the more than $35 billion of cash that it has invested in marketable securities. Financing cash flow is negative, but it is not primarily due to paying down debt. What is fascinating is that the bulk of the outflow is due to the massive amount of cash being returned to shareholders. $35 billion was returned to shareholders via dividends and share repurchases. That trend has continued, with $25.6 billion returned to shareholders in the first 6 months of 2025. So what's the takeaway? With over $47 billion in cash and short-term investments, Meta is using those assets to generate income, which it's returning to shareholders and reinvesting in its business for the long term. So what do I think about Meta and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the three financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interests, we add associate investments. We get an intrinsic equity value of almost $2.2 trillion. We divide by the current shares outstanding. We get an implied share price of about $874 compared to the recent close of almost $718. That is a 21.8% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my thoughts on how to play Meta stock later in the video. So what does Wall Street have to say about Meta? Let's cover that next. Wall Street is generally positive on Meta and sees the company making strides in AI on the advertising front and with wearables. Truist reaffirmed a buy rating with a price target of $880. Truist was incrementally positive after Connect as AI wearables and hardware expand the emerging AI-enabled ecosystem. Citizens reaffirmed a buy rating with a price target of $900, citing traction in Meta's AI-driven creative and ad tools, including video generation, AI business assistant, and scaling messaging ads as a $10 billion line item. Mizuho has a buy rating with a price target of $925, and they named Meta a top long-term internet pick. Mizuho sees Meta as the best to leverage AI, machine learning, and Gen AI across product, engagement, ad stack, and operations. CapIQ gives me a sense of how other analysts on Wall Street view the company. 62 analysts cover Meta on Wall Street. The range is from a low of 658, which is an 8% decrease, to a high of 1,086, which is a 51% increase. The median is 877.50, which is a 22% increase. The overall rating on a scale of 1 to 5 is 1.41, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do have a position in Meta. It is currently a 4.5% weight in my overall portfolio, and I was able to buy shares for under $500 in mid-April during the tariff craziness. If you decide to buy Meta, I'll tell you exactly how to build a position, which I'll reveal shortly. Using data from AI chats to personalize ads can increase impulse buying. This provides a potential boost beyond traditional scrolling and clicking and could be a real game changer. Big Llama distribution partners signals faster adoption by developers and enterprises. Revenue share opportunities with hosts hints at real business model potential. Premium entertainment in headset equals broader use cases beyond gaming. Brand name partners validate the platform and boost time spent using the product. Meta hit an all-time high of $796.25 in mid-August, and it's down almost 10% since then. My model shows a value of $874, which is a 21.8% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Meta is a buy at current levels, but if you're interested in buying Meta, I would be looking to buy below $728 in the $700 to $725 range. If you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Meta is the only diversified, pure play social media company out there, and their integration of AI into advertising is already bearing fruit. While the metaverse is a few years off, Meta is leveraging the success in advertising to fund the future of AI. If you like this and want to see another in-depth stock valuation, check out my super micro video here or my Microsoft video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.